Welcome back to the show. Today we have on a guest named Harold Leishman. Harold is the investment advisor at Canaccord and a team called LLC Private Wealth. Harold's been in the business for 30 plus years now. He has a small cap focus, which makes him a perfect guest for the show. Harold, you describe yourself as a third generation venture capitalist, and we'll get into that. But first of all, thanks for being on the show today.
Thank you so much for having me. I really appreciate the opportunity.
So your family goes back, your grandfather to Saskatchewan, and he was the pioneer venture capitalist, was he not? Tell us about the resource company that he started from the ground up.
So he was a surgeon in Regina in the 50s, and in those days, doctors had spare time, so they would get involved in businesses. And he and some friends listed. It was called a junior capital pool, basically a blind capital pool. And there had been some oil and gas discoveries, or a bunch in Alberta, and they were starting to come in Saskatchewan. And so they thought they would try their hand at that. So they floated this JCP, found a geologist, bid on some land auctions from the government, didn't get either their first two choices, but got their third choice. Had no money to drill, so had to go find a joint venture partner, and it turns out they drilled gushers. It was the largest oil discovery in Saskatchewan for, I think, decades to come. It was the Stellman field. At the time, I think their end of the production, I probably have the numbers wrong, it might have been 2,300 or 2,400 barrels a day at $2 or $3 a barrel, which was a lot of money in the late 50s. And because they were doctors, they thought that they should probably sell it because they weren't, equipped necessarily to manage an oil and gas company. And they had a bid from another oil and gas company, and my grandfather felt that wasn't very entrepreneurial. And he was introduced to a mining company, and they thought they could use the cash flow from the oil and gas side to fund the development of their gold projects. So the company they merged with, the other company was called Tech Hughes, and they merged their company called Canadian Devonian, and the new company after that was called Teck, which I think is still Canada's largest diversified mining company. And at that point in time, it was basically an oil and gas company based on the cash flows from Canadian Devonian, and he was a director of Teck until he passed away. A lot of this is in Norm Keevil's memoirs. I forget, Never Rest on Your Oars or something like that. So that's how the family got into sort of the venture capital part of the business. And I really like the story. I mean, the other two parcels of land they bid on turned out to be dusters. So what I like about that is so much luck involved and so much not a repeatable process. And so the family's been in the business for a long time, mostly taking big blue sky punts like that. My preference is simpler, or maybe a little more consistent, I guess.
Did your father get into the industry, or did he go straight to wealth management?
Yeah, he got into he started in the institutional game in Toronto, and then he moved back out to Vancouver, I guess in the early 80s, and worked on the retail side. For a long time, he dealt for Teck. They had a great business model of funding Canadian juniors. They'd give them flow-through financing, so they'd get a write-off against their income, they'd get some stock, and they'd get a ROFR on the project, and you'd sell the stock. I mean, it became like a self-fulfilling little exploration arm. I don't know why major mining companies don't do that anymore, but anyway.
And then you went to university, graduated with a degree in English and philosophy. I've heard you say in another podcast, I forget which one, that upon graduation, I think you ended up at a grocery store. Was it a?
It was a fish processing facility out in Nova Scotia, Clearwater. I worked for Clearwater. Yeah. And just got tired of smelling like fish and not having any upside. So made my way back west.
Yep. And then joined your father's business, obviously with Canaccord. At I've noticed though in your investing in your holdings that do you ever invest in any resource mining oil and gas companies? Like
Uh,
I
not
ask that
really.
because your roots. Yeah.
Not really. I mean, uh, more likely in some oil and gas opportunities if they're, cash flowing at a decent multiple. But for the most part, it's non-resource based. Um, yeah,
And for the
strictly sort of
viewers, why would that be? Why is the focus on
well,
non-resource?
yeah, I mean, on the resource side, if you have success, obviously you can have a huge win. The biggest risk in the small cap business is uncontrolled dilution. And so, you put your money in at 50 cents and they've got to finance at 5 cents and, you don't have any more capital to put in. You get diluted away. So, my preference are for businesses where they have some semblance of control over their pricing. Maybe they have some speed bumps along the way, but they can
Hmm.
keep making money or breaking even and not dilute at super low prices and ruin my upside.
Yep. Let's reflect on 2024 in the small cap market. How did that play out for you? There's a lot of acquisitions made by private equity, especially from the U.S.
Yeah, yeah. Well, it was a spectacular year. We came off pretty tough 2022, I guess, and 2023 was a little bit better, but a lot of things, a lot of institutions started coming down market and um, driving prices higher. I wouldn't say we had a ton of takeouts. There was a couple where we participated. A lot of the positions we have are still, growing. The valuations are way higher, and we're just trying to manage the position so that, there's not too much risk being overweight in a certain name.
What were the biggest winners for you in 2024?
Uh, Biggest winners, Enterprise Group was a big win. We managed to get a pretty good position down at 42 cents. I don't know where it is now. It's 250 or 260. Vital Hub was a great win. A good position under $3. Um, Trying to think what other names we had. That Kraken was a great one. A
Hmm.
good position under $1. Intermap. Um, Yeah, there was a bunch. Name Silo's been, I guess that's been, yeah, it was 2024. That's started to move. Anything with cash flow and growth really did well.
Yeah. When you first started in the business, working for your father, were you always a small cap investor, or did that
We
take time?
were he was always small cap,
Okay.
but it was a lot of resource investing. It was a lot of rank startup, and you'd go through the cycles, and there'd be times where you could raise money for, every opportunity, but when the bottom fell out of the venture capital markets, nobody could raise money, and then you get into this sort of uncontrolled dilution situation, or companies go broke, or what have you, and like we still did okay. I mean, you'd have your high, we'd always have higher highs and higher lows as a net worth sort of thing for ourselves and our clients, but the volatility was a lot.
Hmm. And you've mentioned this before that people like Paul Andriola and others have helped shape your strategy and how you invest in small caps. Can you walk us through that evolution?
Yeah, absolutely. Yeah, I met Paul at a microcap conference down in California. And one of the positions that we had was a consumer, it was a health and beauty product company. And, it went from 8 cents to, a buck 80 on a bajillion shares of volume because they had, massive revenue and earnings growth. Um, and I was introduced to Paul at this conference, and he sort of explained what his process was, and got me thinking pretty hard about. It sounds like it might be a better path to go down. I think that was around 2011,
Hmm.
and so started listening to Paul and following a lot of his comments on companies, and then invested a lot of time and energy, just building out a database or a process for trying to keep track of all the data inputs, for 60 or 70 different companies, and being able to rank them, by a variety of different criteria or a series of criteria, so that I could also try to figure out what I thought was cheapest, growing fastest, best margins, all that sort of thing.
Well, what was the name of that beauty company that went to a buck 80? I'm curious.
It was the buck 80 might be wrong, but it was around there.
Yeah.
It was ICTV online, or
Oh
it
wow.
was basically it was they were selling beauty products um, via infomercials.
Oh my
Uh,
goodness. Yeah.
is what they were doing, and I learned quite. We always learn when you're investing. You learn something new every time you wade into something. I think eventually it went bankrupt, but we made a nice pass on it on the way through.
And so obviously you go back to your roots and your grandfather being a venture capitalist, and so you apply a venture capitalist lens um, to your investing process and your strategy. Can you walk us through from the top of the funnel how you know focus on that small group of companies, and then why you pull the trigger on that even smaller group to invest in your clients' portfolios?
Yeah, I mean it's I'd love to say we've got like a one size fits all category, but really it starts with, I mean, look, we run screens of the market all the time, looking for companies with revenue growth. We get inputs from other brokers or other investors, whether it's fund managers or people like Paul and Trevor, and ideally looking for companies with low multiples, high revenue growth, high margins, and or some sort of maybe underappreciated catalyst or optionality in the near-term future. Um, and you sort of protect your downside if you've got the valuation metrics right. Knowing which stock is going to be most successful, I think, is impossible because you just never know what the future is going to bring. Um, and basically, yeah, I mean, we're just, you can find something trading for 5 or 6 times earnings and it's growing at 40% and it's got a 20% EBITDA margin. You just have to sort of buy it and wait and see how things progress. One thing that I think most investors probably don't take into account is sort of the macro state of the Canadian venture capital market. So that's something that we track on a monthly basis, and we look at the dollar value traded on the venture exchange and the CSE, in aggregate, and the swings that has over time uh, really sort of drives the direction of these stocks. I mean, they'll go up in a bull market. The liquidity in these things will go up 950% in 12 months, and then over 24 months, it'll decline 95%. And it happens every couple of years. So you kind of need to know where you are in that macro system. And, in 2023, it was trading near all-time lows.
Yeah, rock bottom.
Um, yeah, and it's still pretty early days. Like I think most people in venture capital investments, unless they've been involved in things with cash flow, are still really struggling. Like there's not a lot of interest for uh, you know mining shares yet, despite gold being at $3,000 an ounce and silver being at 33 or wherever it is. I think that might change, um, and you never know what's going to be the catalyst to drive that liquidity forward, whether it's mining or cannabis or you know massive quantitative easing or whatever it might be. Um, but for us, we start with the company level and then sort of manage our portfolio of stocks based on valuations and growth, but always keeping that macro perspective in mind.
Interesting. How do you see 2025 shaping up? Like, where's that trend going in
Well,
terms of
yeah,
liquidity?
I mean, I think momentum has a great way of building on itself. Um, so much money made last year. So much more money is now coming into small caps because small caps are performing. People are like, I need to get into small caps, and it kind of perpetuates itself. And and I'm surprised actually that the junior mining market, I mean, it's starting to pick up. I can see the financings coming across the desk at Canaccord. Um, but at some point, I have to believe that could be a freight train of liquidity coming into the market, and it will lift, not just mining shares, but all Canadian small caps, just because there's that much more money sort of sloshing into the system.
If and when the bull market does come back for in junior mining, like we there was this big super cycle from what 2001 to 2012.
Hmm.
There's exceptional wealth creation. Will you participate, Harold, or will you still sit on the sidelines and focus
No,
on resource?
I will stick to my side of the fence. Like I said, I think it's um, if you're sort of focused on one thing and you get good at one thing, you should just sort of stay with that. My belief is that that drive of liquidity will, give you the multiple expansion for things that are cash flowing and non-resource based, just because there's that much money, more money coming into the system, right? So if you buy something for 5 times earnings and it trades up for, 12, 13, 14 times earnings because everyone's looking for speculations, you've kind of won without taking all the risk.
Yeah. So going back to your point earlier, where you just love finding those undervalued but high growth companies, where you think like you scratch your head before you start investing, thinking what's the market missing? What are the other investors missing? When was the last time where you invested in an opportunity like that? It was almost a sleeper stock, and it just
Yeah, I mean,
crazy.
I would say it's what we're finding now is that um, the market is definitely moving faster, and
Hmm.
so the market's not missing it for very long.
Yeah.
Um, uh, you know, uh, Certainly when we were buying VitalHub, I remember thinking, geez, and we bought a bunch and bought a bunch and we bought more and we bought more, and the numbers they were putting out were great. Um, and then they had one quarter where I think they had a big net income number drop to the bottom line,
Hmm.
and then the stock inflected at that point. Um, but since then, even more recently, you're buying things and you find something, low or mid single digit earnings and is growing at some large rate. And it's harder to get a position because things are starting to move much more quickly. So I wouldn't expect to have, what you just described until, the market craps out again, which is who knows when.
Yeah. Are clients ever sources of new stock ideas where they pitch you something and you look into it, do your due
Absolutely.
diligence? Yeah.
Absolutely, yeah,
Yeah.
and we just always try to keep an open mind. So
Yeah.
in our business, we have a wealth management side. It's all discretionary money, and it's a different kind of business where you're helping people with their financial planning and estate planning and all that sort of thing. Whereas, the client base on my side of the business, they tend to be people who are interested in businesses, they're interested in the stock market, and they don't want to have a fund as just a line item in their account. They want to understand the businesses they own.
Mhm.
Um, they want to make money from it, but I don't want to say there's an entertainment value to it, but there's a mental exercise in, hey, like I'm going to understand this business, I'm going to understand why I own it, and and think about it. And those people often will bring investment opportunities too, because they're also out looking at the market, or they're good sources of feedback. If we have found a company that we think is interesting, and we're starting to build a position, and maybe it's an energy services company or they're selling stuff to energy services company. If this guy has an energy services background, it's probably worthwhile
Yeah.
picking his brain about it, right? And getting some independent, objective views on the underlying business. But predominantly, we're driven by the numbers.
Yeah. Let's talk about the size of your client portfolios. Diversified or concentrated? What's your
We
philosophy?
we like a diversified approach,
Yeah.
and we like to manage the positions so that you don't become too overweight in one name. Um, and it also depends on the size of the account. So our bigger speculative accounts are maybe a couple $1 million. They'll have more positions. We feel they're better able to take um, higher concentrations of, high conviction names. Smaller accounts, might be, $100 or $200,000. And we like them to be more diversified and much more disciplined in how they manage their portfolio. Just from a risk management perspective, if that makes sense.
Yeah. What would you say is the company that you've held in clients' portfolios for the longest, if you can think back?
Well, Vital Hub would be there. We still own it. I mean, we've trimmed it a number of times for clients. Enterprise Group, we still own that. Well, we've trimmed that a number of times. So we're not afraid to hold something for the long haul. We just don't want something to be 25% of someone's portfolio because something happens and now you're underwater, right? So
concentration risk, exactly.
Mm-hmm.
And what are the commonalities? Like if we look at, you talked about the quant side, obviously the numbers. Do you also reach out to management teams before you take a stake in companies?
No, we always reach out to management teams, but we'll certainly start aggregating a position, based on the numbers. If something's put 4 or 5 quarters of growth together, and like I said, it's trading for a low multiple, and we've got a position recently, which I won't get into the name, but they were trading for 5 times earnings, and earnings were growing at 75%. Revenues growing at 40%. So we started nibbling away. We did have management come in and explain what their game plan was and what their objectives are. We've taken a fairly sizable position. Management's track record is, I'll call it, there's some spotty bits in there, but we'll hold it as long as the numbers make sense and nothing too crazy happens.
Let's say you have a company in your clients' portfolios. They post a Q3 that's underwhelming, under expectations. What do you do? What action do you take?
Well, you need to understand what's driving the lack of performance. Sometimes, orders can be delayed by a quarter. We do try to bear in mind macro themes. We think there's probably some recessionary forces, so we're probably a little more tentative on, consumer discretionary names. So we do look at that, but a bad quarter, one bad quarter, you have to understand it. A second bad quarter, maybe get a little harder nosed. If there's a third bad quarter, then you really need to be making some changes, I think.
Yeah. What investment would you say has served as the best lesson for you currently? Could have been a company that didn't work out, or you had to trim it early on, right after investing.
Sorry, ask that again. The biggest lesson of a current
investment. The biggest lesson that you drew from a past investment that's basically largely shaped your investment philosophy.
Yeah. Well, yeah. Just sort of getting back to your comment. I remember one of the deals I did with Paul ages ago. Was a little company, and it was trading for 6 times earnings and 1 time sales, and it was growing at 50%, and they had 50% gross margins, and we did a little financing to convert their. They had some debt, so we converted their debt to equity for our clients. Stock had a huge run. It was a 10-bagger. The institutions came in and they put in money. Like I think our financing was 12 cents. They came in at $1.10, and they paid. I don't know. It was like 7 times sales and 65 times earnings at that point. So we were doing really well. We had a big win, but then they started posting negative growth. whatever cycle they were in sort of rolled over, and it was the same thing. It was, one bad quarter, then it was like another bad quarter, and of course the analysts are, writing, yeah, it's soft, but we think it's going to pick up on the opportunities, and the stock had pulled back a little bit, but the biggest lesson there was, if you decide to sell something, just keep selling it, even if the stock goes down, and you know, don't get too cute. And like we made some money on that name, but we did ride a lot of it. We left so much profit on the table, because it ended up going down to basically zero. So if you sell it and it turns around and starts to outperform, you can always buy it back, more than likely. So I think that was a key driver for me. And the other benefit we've got is there's sort of three of us on the decision making side. So we've got a full-time CFA. He does a lot of the scrounging through and narrowing down our investment universe, and then myself and my other two partners will sit down and hash it out and talk about it and ask questions and figure out what we want to do in terms of taking a position or managing the position, or if it's time to exit.
Yep. Do you ever dip into the mid cap space? Stocks with a market capitalization of $1 billion or more?
No, I leave that to my wealth management partner. No, we focus purely on the micro to small cap space. Over 500 million. There's a lot of competition in that space. We're much happier. Much smaller names. Call it sub $200 million. Even 20, 30, $10 million businesses are places you can build meaningful positions for not a lot of money.
Yeah, and I've heard you mention this before, and you just alluded to it here, that the jockey is so important when it comes to small companies. How important, though, is it that the CEO is also the founder-led companies? Does that matter?
Yeah, I don't think that matters. Well, I shouldn't say it. I shouldn't say it doesn't matter. I think it's who's going to drive the vision forward. So, you could have a broken business and a new CEO comes on and starts turning it around. Does it matter? I don't really care who's driving the growth, as long as there's someone driving the growth. I think they should have some history in the space. Certainly like to see management where they put their money where their mouth is, where they are willing to buy a position. I think that matters. Certainly seen a number of businesses where management, has no position, like a no stock position, or only options, and I think that's less interesting. I think if you believed, you would put some of your capital where your mouth is.
Yeah. Do any of your clients ask about Bitcoin? There's been a tremendous run-up.
We get not so much anymore. We used to get more of that because the last little bit's been so successful. Honestly, we're going to call them with the idea, and they generally just say yes. Occasionally, people will take a win and they say, "Oh, I want to put some money in a mining project or a crypto deal or a Bitcoin ETF or whatever." And it's like, okay, fine, you can do that with the win, and it doesn't matter. I think the last client who called and wanted to, buy a mining stock, I'm like, well, just, buy it at one of your other accounts. Don't do it here because we're working with your capital and we're being successful. Like, let's not dilute the pot.
Yeah. What's your take then, Harold? I think I know where you're going with this on Bitcoin and the future of Bitcoin.
Do you know what? I completely missed it, and I don't truly understand it, and so I don't really have a view. I've been told I'm wrong, but I struggle to a certain extent with. I understand the scarcity of Bitcoin. but I don't think there's a scarcity of possible cryptocurrencies. Unlike gold, where there's a scarcity of supply and it's really hard to get out and da da da. I think having multiple cryptocurrencies is possible. Certainly, Bitcoin is the most prominent, and so it gets this huge premium. Expensive to maintain. Very inefficient from an energy perspective. But like I said, I say that and I didn't make a single dollar off of it. So what do I know?
This next question I want to ask to help viewers navigate the market because the small cap market is very tough to invest in. I've probably like 90% even more companies just don't work out. So what would be your criteria hypothetically, Harold, to help viewers navigate this market in shorting a company? Basically, what are the companies that you want to avoid, and what do they all have in common, basically, in the small cap space?
Yeah, well, I would never encourage anyone to go short venture capital companies. I think that's an easy way to lose a lot of money because there's huge promotions and pump and dumps, and you can get badly hurt. Mm-hmm. No matter how poorly managed or overvalued a company might be. I think companies to avoid are companies where they're in a product development, but there's no proof that there's any market for the product. So I think those are worse than at least with mining companies. You're going to put the money in, you're going to drill some holes, and you'll know. Although most of the times what you get is more question marks than conviction with drill holes. But I think product development companies, the product's never finished. They always need more money to add another widget or feature or something to the product, and they haven't proven that they can sell anything or that there's even a market for that product. Actually, I remember when I was first speaking with Paul Andreola, his comment was, the proof of a good business plan is when they're selling lots of stuff. Right? If revenue is growing, then they must have a good business plan. Because before you just get business plans all the time. Well, look, we're going to open a new sandwich shop chain, and it's going to be great. And here's the metrics, and here's why, and we haven't sold a sandwich yet. I think those are the things to avoid.
Yeah. So avoid pre-product fit, pre-revenue companies.
Pre-revenue concept.
Yeah.
High value. Yeah.
And from all the different management teams that you've talked to at these public companies, what are some of the red flags that stand out to you where you say, nope, I'm not investing?
Yeah. Not investing. It's well, that's a tricky one because they some of the management teams have poor corporate governance structures. I'm the CEO, I'm on the board, my wife's on the board, my kid's on the board, there is no.
So who's keeping who in check, right?
Yeah, right. But having said that, we passed on an opportunity recently where we kind of looked at it and said, oh, this makes no sense. We see the revenue growth. Of course, then he immediately went 10x. So that's why I'm kind of like hedging my bets. Do I want to say I wouldn't invest? Like I wish I had invested.
This is the beauty about the market is absolutely not linear, right? It's there's just so much optionality, right?
That's right. There's always more to learn. Lots of chances to receive an education, and getting an education is not always cheap. Sometimes it's expensive.
Do you care about upcoming mega trends? Like, are you thinking what's next after AI, or are you just completely bottom up? It's all about the business.
All about the business.
Yeah.
Because I don't know enough about AI to come up with an investment thesis where I'll have any sense of confidence. Trends are tough. How do you know what's going to stick? And that was always the problem for me. You get into a good mining market and you're long a mining stock and the stock goes from, 50 cents to $2. is it expensive now? Is it good? Is it bad? How do you figure out what the valuation is relative to their perceived asset, um, and an overall market that's going through either a liquidity expansion or contraction.
Yep.
So that's why for me, I just find it way simpler to have numbers that you can point to. And like if you're a client to say, hey, we paid 50 cents for the stock, it was 5 times earnings and it was growing at 20%, the market's fallen to pieces, so now it's trading for, it's been cut in half and now it's 2.5 times earnings and it's still growing at 40% or 30% or whatever. How unhappy are you? No one likes to see their stocks go down, but your sense of conviction is quite strong when it's just objectively based on numbers.
Mm-hmm.
And I think that's an important part of investing too, is having the courage of your convictions. And how do you have that unless you can just point to it and say, well, it's going to pay itself back in 2.5 years.
Absolutely. When a stock halves itself, most people think, you know what, just sell and run basically. But conviction plays a very, very big role.
Yeah.
Speaking of trends, and this will be a headwind for this year, potentially for a lot of industries in Canada. When you heard about the Trump tariffs, did you sell out of any positions? Did you trim any positions as a result?
We certainly went through every position and talked to every management team to try to figure out, whether their businesses would be subject to tariffs.
Mm-hmm.
Because companies are listed in Canada, it doesn't necessarily mean that they're in Canada and exporting to the U.S. You take VitalHub as an example. It's, Canadian listed. Most of their business comes from the U.K.
Yeah.
Some Australia, some Canada, and a lot of Canadian listed businesses have significant U.S. businesses, but they're actually have a U.S. corporation where they're paying U.S. tax. They hire or employ U.S. people, and they're either selling into the U.S. or globally. So I think we only had one name where we think that they could be subject to tariffs in a meaningful way. And I think at the time, we were bought it at 10 times earnings, and it's come down a little bit. They're still making money. We know they'll have an active NCIB not too far away. So you're kind of like, well, some of the catalysts are still there for upside. So no, we didn't sell it, but we're not adding to it now that it's pulled back a bit, because we kind of want to see how that plays out.
It's just trading sideways, and I'm sure the other existing shareholders are thinking the same.
It's down a little bit, and you're like, okay, well, you paid 20 and it's trading at 15. It's kind of it's not necessarily meaningful. On the conservative portfolios, they're sort of a risk first approach. So as volatility starts to pick up in the markets, as correlations start to pick up, it kind of prevents itself from investing. So it's at 25-28% in cash right now, and certainly the tariffs are playing a large part of that, where you're not quite sure how it's going to play out. And so for those larger cap portfolios, you can kind of easily sit in cash and wait for some resolution. The small cap, micro cap, there's not the liquidity necessarily, if I bought 2 million shares that I can turn around and get out tomorrow.
Yeah.
So
you've got a team that supports you, Harold, in the stock selection process. I'm curious, I've asked others the same question. Are they using Gen AI like ChatGPT to, help in the stock research or the discovery process?
No.
Okay.
No.
It's
I mean,
too
look,
dumb.
we no, we don't. We certainly use Bloomberg and other tools to run screens, but then we compile our own financial data, and we try to keep things on a 3-year trailing sort of period, so you can see trends that might be emerging. Our revenues, our revenues flat, but margins are getting compressed. Well, that's kind of worrisome, right? So, but no Chat GPT. Maybe we'll use it to write some scripts for trying to, get information to clients that's clear and concise. because writing is a laborious process. You're an author, so you know how hard it is.
Oh yeah, it takes forever. Yeah,
Yeah, and I'm
especially a
not an author, and it
600-page
takes me
book.
for forever. So I'm like, so I would use it. I would use it for that, to try to make the message clear for clients. Um, but not screening stocks. You kind of have to dig in and understand what the drivers of the business are, what the operating levers are.
Yeah,
What's management saying? What are they not saying?
and that's why there remains a big edge, right, for people
Yeah,
hunting in the small cap space. Yeah.
yeah. And um, I would even say, the data you get off of a Bloomberg for small caps, a lot of the time is incomplete
Mm,
or inaccurate. So you really have to go in and generate your own data and understand it. I think you had an interview with Jesse Gambler. I know he said it in previous interviews that they build their own models, right? You have to have your own data set and understand it and
hmm.
believe in it, and kind of go from there.
Yeah.
Canaccord's got a great quant platform for mid caps, large caps. It's global in nature, but very few of the companies that I'm picking show up on it.
Yep.
Every once in a while one does. And that's always interesting because I think, well, maybe an institution somewhere will pick it up if they can find it.
And that's the dream, right? Exactly. Once the institutions
Yeah,
start investing, and then there's a major tailwind
yeah,
for the next
yeah,
5x. That's the
yeah. Well,
dream, right?
they've got so much capital to deploy. Like
Yeah.
it's hard.
100% Canadian small cap equities, or do you also hunt in the U.S. for small cap?
We're 100% Canadian.
Yeah.
Because we think it is got the least competition and is the most inefficient. Um, you get down to the OTC and that sort of stuff. I mean, I don't think they necessarily have to have audited financials. So I think having audited financials is a definite plus. Um, and yeah, like I said, the liquidity swings in and out of Canada are so abrupt and so extreme that you can play that to your advantage. And really, and I forget the numbers. There's like 2,700 companies on Canadian venture markets. Maybe it's the TSXV. I'm not sure. And maybe 150 or so of them even have revenue. So most of the venture capital focuses on mining,
Yeah.
oil and gas, or whatever the latest trend is, whether it's AI
Mhm.
or something.
Yeah. Cannabis was a
Cannabis.
huge
Yeah.
mega trend, right? Up until
Oh,
2018.
absolutely. Yeah, yeah. I'll send you our liquidity, our
Sure.
monthly liquidity chart, and you can see, it goes back to 2008. So you can see, big mining markets. You can see cannabis. 2021. I mean, everyone's at home trading in their pajamas. That was a whole
Yeah.
different.
I'd love to see
Uh,
that. I'll share it in the newsletter as well, that chart if you send
yeah,
it to me.
yeah, and we think it's a critical piece for knowing where you are. And sometimes, honestly, you just have to take smaller, at the top, take smaller punts and expect to make less money and just hold a lot of cash.
Yeah. So
So,
let's say that some of the viewers here are future clients of yours and they're just starting out building their own stock portfolio to start. $50,000. How do you go about it? How do you, like double the money basically in 5 years? What do you do?
uh, double the money in 5 years. Okay. Well, I think obviously that'd be a disappointing result, but I I
Conservative?
I think yeah, I think you just have to really clearly define um, what you're going to invest in. As people say, the buy side is easy, the sell side is hard. Especially if you've invested a lot of time into researching a company and getting to know it, and maybe you've made some money on it, to turn around and say, you know what, I think I'm done with this now and I'm going to sell it. I think it's hard for people. So I think if you buy something, you should write down a clearly defined
Mm,
sell point
yeah,
or trim point
yeah,
or a combination of them. If growth were to go negative, I would sell this at any price.
yeah.
Or if growth starts to moderate, I would trim or something. Or even if hey, like the stock's doubled, how am I going to deal with that? Diversification would be key. Um, I know a lot of people in the small cap space believe in having, very concentrated portfolios of maybe
Hmm.
putting most of your assets in, 5 or 6 or 7 or 8 names. I find that more challenging, and I think it doesn't necessarily account for the randomness of the stock market. And so I like having more ponies in the race um, than that. But yeah, have a clearly defined sell strategy. Figure out what your allocation is, for an opening position. If you're going to have 10 positions, that's $2,500 a position. Sorry, that's $5,000 a
Yeah.
position. If you have 10 positions, I would argue having more positions is better.
And you alluded to this earlier on. I think you're alluding to special situations when you mentioned sometimes you look for short-term catalysts in companies. What is your thought process there? Your mental model that you employ for special situation plays that might not be
Sure.
long-term holdings.
Yeah, no, for sure. And again, it comes down to, you look at a company. We were looking at one recently, and the thing trades for book value, and it doesn't really make money. It kind of breaks even, makes a little bit, never really loses much. But there's this underlying value that you can kind of point to that will support the share price. And then they've got some, new products they're launching this year, with some larger partners, that could be game changers. So I'm like, well, I'm going to buy that for my clients and myself. We only recommend to clients what we're going to be buying ourselves.
Yep.
So we don't pitch stocks just for the sake of pitching them. It's like, hey, this is what I'm going to put in my portfolio. Do you want to come along? Um, so there's a company that's going to have this near-term catalyst. It's 6 to 12 months. You should start to see it in the revenues. And if it doesn't work out, well then you can sell it for what you think is going to be a better performing opportunity at hopefully what won't be much of a loss because it's
Hmm.
trading for book value, right? Liquidity comes into play when you're buying and selling these things.
Hmm.
Um, but I don't want a catalyst that's 5 years out because I might not make it that long.
Best part about the job, in your opinion, Harold, what would it be?
Oh, best part about the job, there is I love dealing with people. I love
Yep.
talking to people. Um, the thrill of having a stock run is unlike anything else.
I agree.
So it is an absolute total rush, and so I live, and my partner on the small cap side, we live to find those companies that give us that hit.
And as you said, sometimes the hit can be parabolic. You could be
Oh
invested in
yeah,
the company for 3 years, it trades sideways, it's a micro cap, small cap, and all of a sudden just so many new investors come in, it catches the institution's eyes. It's just
yeah,
parabolic sometimes. It's great.
yeah, and sometimes it's if you get really lucky, it's instant, and that's almost not as good. Like we think we bought a block of stock. Um, Maybe it was 18 months ago. And so we bought it for clients. There wasn't enough to go around, but everyone got a little taste. And then, 4 days later, the stock doubled. Well, I hadn't had a chance to buy any for myself, but I'm like, you know, it was fun, but it was almost too fast in that you didn't get to appreciate the daily increase of its ripping. Um, but yeah, that's the best part. Having
um,
having winners and making clients money
Absolutely.
is just an awesome feeling.
Yeah. Favorite books. What would you recommend to viewers to read out there who want to hone their
Favorite
skills in investing?
favorite books. Um, Reminiscences of a Stock Operator
Mm-hmm.
is
Jesse
is
Livermore. Yeah.
yeah is a great one. Because he spent a lot of time talking about uh, the emotion or playing on the emotions of his counterparties in the
Yes.
market um, and how that can work for or against people. So I think
It's so
that's
true.
I
If
think
people
I think
people don't want to read the book, they can go to Google and type in Jesse Livermore's 21 rules, and his 21 rules, I think I need to make into a poster, by the way, and hang it up on the wall.
Yeah,
They're amazing.
yeah, it's great. For new investors, young investors, like for my kids, the psychology of money is a great starting point. Um,
Morgan Housel?
yeah, yeah, because I think it talks about, people have biases depending on when they grew up
Yeah.
and what their family situation is. Like I know when I speak to my father about investing, he always harkens back to, when inflation was rampant and mortgage rates were 22% and
Yeah.
blah blah blah. I'm like, okay, well, yeah, I can, but that drives a lot of his
Yeah.
thinking when he looks at, the economic universe.
Just buy more gold, right, Harold? Gold and silver.
just
That's all you need to do.
just buy more gold. That's right. Um, yeah, and What Works on Wall Street was one that I really
O'Shaughnessy.
liked. Yeah, so
Mm.
and that was really instrumental for me when I was building up my data set and how I was going to look at the data. If you look at his, top performing return, it's all about sales growth and microcap. Um, and you can run Bloomberg backtests, which will show you the same thing. And so, trying to capture that data as best I could was really valuable to me. You have to really like investing to like reading that book.
It's a big book. It's
It's a
huge.
big
It's like
book, and
700
it's just
pages.
a lot of data and
Yeah.
tables and stuff. Um, but I thought it was quite useful for sure.
Yeah.
Um, so those are three books, I guess, that I appreciated. Um, you can get into intelligent investing and everything else, but I think you really have to be a valuation guy if you wanna go down those paths.
That's usually the entry level book, right? Ben
Yeah,
Graham's Intelligent Investor. Absolutely.
yeah,
Yeah.
yeah. So,
Okay. Well, this has been a lot of fun, Harold. I appreciate the conversation, and I wish you the best for 2025. Thank
hey,
you.
thank you so much for having me. I really appreciate it.